Welcome back, guys, to my new series of videos that attempts to take complex trading concepts and simplify them down so that anyone can understand. In today's video, I want to talk about the approach that professional traders take in order to determine whether or not to take a specific trade setup. Professional traders don't take every trade setup that comes their way. Rather, they focus on those trades that yield a statistically positive expected outcome and avoid those that don't. And this is why they focus on the two biggest factors that determine whether a trade is worth taking or not: risk to reward and probability of success. Your risk is how much you're willing to lose if the trade fails. Your reward is how much you stand to gain if the trade plays out in your favor. And the ratio between those two gives you a starting point, but it doesn't tell you whether a trade is worth taking by itself. A trade is only worth taking when the risk to reward ratio and the probability of success work together in your favor. It's the combination of risk, reward, and probability that determines whether a trade makes sense to take over the long run. Let's break it down with a simple example. Bitcoin is trading at $50,000 and you think it's about to bounce. You buy one Bitcoin at $50,000, place your stop loss at $49,000, and set your take profit target at $53,000. You're risking $1,000 and you're aiming to make $3,000, what we would call a 1-to-3 risk to reward ratio trade, or a 1-to-3 RR trade. Without taking into account probability of success, this sounds like a no-brainer. This is about as far as most novice traders go when it comes to deciding whether to take a trade or not. But professionals know that the math is actually only good if the probability of success is high enough to justify taking the trade with this level of risk to reward. Let's talk about probability. You can think of a trade like a game. If I tell you, flip this coin, if it's heads, I give you $3, if it's tails, you give me $1, you'd flip that coin all day long. Because even though you'll lose 50% of the time, you'll make 3 times as much as you'll lose when you win the other 50% of the time. And this means you'll have a positive outcome or expected value over time. We'll touch on expected value more in a bit. For now, let's go back to the trade example from earlier with the 1-to-3 RR trade and see how probability of success changes everything. Scenario 1. A 1-to-3 R trade with only a 10% chance of success. You'll win 1 out of 10 times, meaning in a series of 10 trades, you will, on average, end up making $3,000 once on the win and losing $1,000 9 times on the losses, meaning you end up gaining $3,000 on the one win, but you lose $9,000 for a net loss of $6,000, which tells us that this was a bad trade, even though the risk-reward looks good. Scenario 2, the same 1-to-3 risk-reward trade, but with a 40% chance of success. You win 4 times for a net gain of $12,000, and you lose 6 times for a net loss of $6,000. Overall, when you add the gains and the losses together, you end up with a net gain of $6,000. The same exact risk to reward as our previous example, but a very different outcome, solely because our probability of success for this trade was 4 times higher than the prior one. And this alone made the difference between a $6,000 loss versus a $6,000 gain over a series of 10 trades taken with the same 1-to-3 risk reward ratio. This is the foundation of expected value, or EV. Expected value combines your risk, your reward, and your probability of success into one picture that tells you whether your strategy makes you money over the long run or not. Let's go over another example to demonstrate why expected value is so important. Most people tend to think that a high RR setup is automatically good and that a low probability setup is automatically bad. However, this is not always the case. For example, if someone offered to pay you $1,000 if you could beat LeBron James in a one-on-one pickup game, but you'd have to pay them $100 if you lost, would you take that bet? Probably not, because you realize that even though the risk reward might be in your favor, 1 to 10, the probability of success is not. You know that you don't have even a 2% chance of beating LeBron in a fair match, because he's taller, faster, and stronger than you, and he plays basketball for a living. Meanwhile, you only like to play basketball casually on the weekends. This is an example of a high RR setup that is not good to take because the probability of success is so low that the overall expected value, or EV, is negative. On the other hand, you can have a low probability setup with such a high risk to reward that it actually makes sense to take the trade, despite the low probability of success and even if you lose more often than you'll win. For example, let's say you're at an NBA game during halftime and you get the chance to shoot a half-court shot, which pays out $100,000 if you make it. All it will cost you is $100. You know from experience that you tend to make a half-court shot around 1 in 50 times. This means your probability of success is quite low at 2%. However, in this case, the RR is so good that despite the low probability of success, the expected value is actually positive. Over 100 attempts at the shot with a 2% chance of success, on average, you would win 2 times and lose 98 times for a net gain of $190,200. This is why looking at risk to reward or probability of success in isolation can be extremely misleading. Now here's the important part. You can't always calculate your probability of success perfectly. There are too many variables, market conditions, volatility, liquidity, news, etc. that make it almost impossible to accurately backtest a unique setup. But over time, through experience and tracking your results, you develop a general idea of what type of setups tend to work for you and how often they play out in your favor. You can also use a trade journal to keep track of the trades you take and their outcomes over time if this helps. Maybe your breakout trades tend to win 60% of the time on average. Maybe your counter trend scalps win 30% of the time. Maybe your trend following trades win 50% of the time, but generally have a higher risk to reward ratio. All of this helps you decide which trades are actually worth taking. So here's the formula the pros use when it comes to deciding whether or not to take a trade. EV, or expected value, equals the probability of success multiplied by your reward minus the probability of failure multiplied by your risk. If that number is positive, the trade has a positive edge and is worth taking, even if you're wrong more often than you're right. A quick example. Let's assume we are trying to decide whether or not to take a trade that has a 1 to 3 risk to reward ratio. We know from experience that this particular setup doesn't tend to work out more often than not. And from our journaling over the last 6 months, we approximate the probability of success for this setup to be around 40%. We are looking to risk $500 on this trade and so can expect to make $1,500 if it plays out. Let's plug all this information into our formula above to determine if it makes sense to actually take this trade or not. Expected value equals 40% times 1,500 minus 60% times 500, which equals 600 minus 300, which leaves us with a net positive expected value of plus 300. This tells us that this trade is worth taking despite the lower probability of success, because on average and over the long term, we would expect a net positive value if we continue to take this trade setup every time it presents itself. To recap, risk to reward tells you how much you stand to lose versus how much you stand to gain if the trade plays out in your favor. Probability of success tells you how likely the trade is to actually play out in your favor. And expected value combines both into one number that tells you if a trade is worth taking or not. Trading isn't about luck or prediction. It's about playing the math in your favor over a large sample of trades. Proper risk management involves considering both risk to reward and probability of success in order to estimate the expected value of any given trade before taking it. Get the math right and the results will follow. If you guys enjoyed this video, please like, share, and subscribe, and write down in the comments there what you'd like me to cover in our next lesson. I hope you guys enjoyed this video as much as I enjoyed making it, and I'll catch you guys in the next one.